Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, I woke up this morning and I was like, you know what? Let's just not do this. Let's just, start vacation early and everything. But then I remembered that tomorrow we have non-farms and retail sales all in the same day. And I was like, let's go. But today's probably going to be really quiet. In fact, coming in here, looking at the VIX, not the VIX, but like volatility implied by the at-the-money options in the Treasuries, we're getting a reading of 4.68, which is the lowest I've seen. The lowest I've seen. So yeah, probably not going to be a ton of really great opportunities today. But I actually kind of suspect that we could outperform that. And I'll tell you why in a second. Hold on, I'm not hearing the music here. I need to turn on voice meter. Hey, Paul, I also didn't expect the mostestus today. Yeah. Okay, so let's check our volume profiles and everything. So we kind of sold off on Friday, but in the overnight here, kind of not really any rhyme or reason to it, but we did move up. I think one thing to note, if we come over here to the Japanese yen, is that the Japanese yen strengthened considerably. Do we have a rollover here? Ah, there we go. It's like, why is it? It doesn't look right. There we go. That looks a little bit better. Well, so the Japanese yen strengthened considerably, and maybe that is taking... Although that doesn't really make sense, because the reason the yen is strengthening is because they are definitely going to raise rates in Japan. So S&P 500, on the other hand, kind of had a bit of a sell-off on Friday. What was the news? I don't even remember now. Oh, hold on. I have the speakers on. It was something to do with Oracle, but I don't remember what it was. They made like another announcement about data center spend. Oracle took a dive and kind of took the rest of the market with it. So, hey, we were like really on the right track when we were talking about like we really need to pay attention to Oracle earnings and everything last week. Anyways, oil. Oil was up a little bit because maybe some higher demand from China, but it looks like it gave that up pretty quickly. Bouncing off that 57 again. Gold and silver. Well, gold bouncing back up here. Okay, when you start getting that sort of stuff, that's wild action. Gold is a high flyer all of a sudden. Okay, silver not quite making the new highs. Copper's going. But copper, I think that's China. It may be the other metals, because there is a lot of the demand that we get in the metals, in gold and silver, comes from China. So copper. And then we already talked about the yen and Bitcoin. Well, Bitcoin is at the lower end of this consolidating range that we got here. But I don't know, not too big of a deal. All right. Since it's Monday, let's come over here and pull up a calendar. Well, by the way, we had this morning Canadian numbers, didn't we? Let's see here. Where is it? Thought it was Canadian CPI. Maybe not. We have Fed's Hammock speaking right now. Goolsby will be speaking at 8:30. And I think we're supposed to get Moran, but I don't see him on the calendar. Yeah, he's not on this one either. Oh, yeah, he's on this calendar. I don't know why he's not on my Financial Juice calendar. That's interesting. Oh, no, wait, you know what? This is probably, I need to refresh, maybe? Because it's not the 12th. Yeah, okay, so here's Canadian CPI year over year, 2.2 versus expected 2.3. Okay, so Moran speaks at the market open. Oh, we need to come over here. Moran speaks at the market open, essentially. Oh, wait, that's what I have on here and what I have on Financial Juice contradicts. They have Moran at 7:30. And, oh, no, wait, no, what? Oh, Moran is speaking twice. Speaks at 7:30 and 9 o'clock. What's the 9 o'clock one? Due to speak in an interview by CNBC. Well, Financial Juice doesn't list what they are, but they have them on there twice. Once at 7:30 and once at 9. Whereas this one only has it at 9. 9 my time. So like 11 Eastern time. But Moran is expected to give a justification for why he dissented. I don't know. It's probably going to be pretty similar to what it was before, right? But that could move the market. And we did get a fairly decent opening range, right? The new version of Jigsaw puts like the open in there every day. And it's kind of funny that it doesn't delete it. Is there another parameter in there somewhere that puts that in there? Huh. Yeah, because I got like these opens everywhere that I don't need. That's funny. I can just do this. Okay. So while the volatility is really, really low, Moran could say something that could beat those expectations. There may be something going on here, it being a Monday, that the options aren't expecting. And then tomorrow, I would expect the volatility to be a lot higher because you're getting the news. Now, it probably won't be as significant. I think there's still some things in the data that are likely to be a little wonky. And in fact, let's just remember that at the Federal Reserve meeting last week, Powell said some things that, so there's always this big speculation when there's a Fed meeting just before the non-farms number, if the Federal Reserve has those numbers or not. And they're always a little bit coy about it, but my understanding is that sometimes they do and sometimes they don't. And he said some things during the press conference that kind of makes me think that he has seen the numbers, because he was saying like that he would advise caution about what we read into the next report because there's going to be some things in it that kind of distort the results. So I think that means, and I don't remember exactly what the reason was. He gave a reason about why it would be distortionary, but I think that means that he knows the report tomorrow is going to be weak, but that it's not actually as weak as it seems. So tomorrow will be a big day, but it probably won't be as big as the January non-farms, which really, when you think about it, isn't that far away. 2 weeks or whatever. So that's what we kind of got here. But today it's... I saw this TikTok this morning. TikTok has been like, oh yes, maybe you are into trading. We'll show you trading influencers on TikTok. Which, man, I tell you, the trading influencer kind of people that I see on TikTok just seem so clueless to me, man. I usually don't watch all the way through though. Like, I usually look at this and I'm like, okay, like, you're 19 years old. You're in an empty, plain room. I don't think you know anything. makes you think about the other type of influencers overall. Well, yeah, it kind of does. You know, it always brings me back to that whole thing. Like, if you put 1,000,000 monkeys into a room and you lock them in there long enough, eventually one of them will write the entire works of Shakespeare. Just by pure random chance, they're just going to randomly type it out. And when that happens, you know, there's going to be all of these people are going to want to interview the monkey, and there's going to be all these books about the monkey that wrote Shakespeare and the habits and all of the things that they did, so that other people can learn from that. And it will be almost impossible to tell that monkey that he is a monkey. Right? Like once people have made some money, our society holds that act alone in such high esteem that it's literally impossible to convince them of anything. You can't convince them that they were just lucky, you know? Why would you become an influencer besides the fact that you failed in your domain? Well, I don't think that that's true. So there's one thing. So something I want to push back against in the trading space in particular is this idea that nobody would become an educator unless they failed at doing it. And I think the reality is actually more that being successful at this is not as lucrative as everybody thinks. That's the thing. If you're really doing this in a way that is like reliable, like you're really deriving real edge from it, and you're doing all of the appropriate things that you need for risk and all of those sorts of things, the actual return that you get from it is not that much. You can come in and you can be amazing at it, and you can make like 20% per year, but that's on $1,000. You're only making $200, right? So what are you going to do? You're going to make software. You're going to teach. You're going to do all of these other things, right? To make the money that everybody thinks that they're going to make from day trading, you basically have to get lucky and hit it big and do things that are frankly stupid, right? So there's going to be plenty of people out there teaching things that are objectively useful things, right? But the other side of it is, even if you had a guy that he was just massively successful, like they've become a multi-millionaire from trading, and they came and they made a course, and it's free, and you can just go and watch the YouTube videos, and it has everything that you need. It would still be the case that the majority of the people that would take that course and try to trade would fail, right? When we're actually giving you the information that can make a difference for you in day trading, it can only take you so far, because the nature of the market is that on the midterm time frames, it's mostly random. So I think the truth is somewhere in between. I strongly believe that a lot of influencers became influencers because they couldn't act on things in their domain, but they believe their knowledge is huge. But that's true. Some people are better at teaching, some practicing. Yeah, well, so I'm thinking about like other areas. You know, I remember there's this one guy, who I kind of like, but his whole thing was that he wanted to become a chiropractor, so he went to chiropractic school, and he realized that it's all pseudoscience, right? So he came back out and started kind of looking at more like peer-reviewed sports kind of medicine sort of stuff. But like the reality is that your whole thing is based on being a failure. Like you went to the thing and you decided the thing was nonsense, and then you came back out and started doing your own thing. That doesn't necessarily mean that you know anything, right? You know as much as I would know if I decided to go out and spend all of my time reading sports medicine. Well, there might be some flaws in your understanding of that, right? And it is very similar to me, right? Because my whole thing was I wanted to trade, but I didn't realize that that's what I wanted to do until I was basically graduated from university. So I just went into tech at a bank and took all of the information that I had from working tech at a big bank. Now in my case, I think that that's kind of an advantage to me because it made me aware of how they do things and the kind of information that they look at in a way that I was not, subject to the same kind of restrictions as anybody that's in the industry. There's a lot of people in the industry that can't really talk about this stuff. Like they use the square root law of metal order impact in their job every day, but because they were taught by the firm, they're never allowed to talk about it. That didn't happen to me. I had to learn it on my own, and so that's why I'm able to talk. So it's an advantage for me in that case. But you get what I mean. At the same time, though, most influencers were never based on even necessarily any kind of success. Right? Most influencers were just based on people liked them. So I don't know. I do question. I've watched a lot of social media. I feel like I've learned a lot of interesting things, but at the same time, I kind of think that a lot of it is just junk food. Like, is every second that you spend on TikTok a complete waste of your time? Maybe it is. I don't know. But when you want something to occupy you and you only have like 30 minutes, well, I don't know what else you can do. Well, now the issue that I have is that I basically have 2 hours a day. 2 hours a day where I have to sit in a car and drive. If not 2.5 hours. Because, man, let me tell you, driving out of the Utah Valley is a complete nightmare. Going there is okay, and I get there in about 40 minutes. But coming back, sometimes it takes me an hour and 20 minutes, and it's like parking lot the whole way back. It's a big freeway, too. So that place just grew so much faster. It's like what's happening in Utah is everybody woke up and suddenly realized that they're in a metro area. we don't have the infrastructure for it. We really don't. So I guess I need to like get audiobooks and stuff. Something like that. I don't know. Because at some point, just listening to music is going to get old. And have heard all of the podcasts that I'm going to do. I need to get. I digress. I think the reason I was talking about that, though, I don't even think I got into the reason why I was talking about that. There was this kid, he came in and he was like, well, if you're not making more than $1,000 a week from your trading, then you should never be resting. And I was like, you should learn about a little thing called volatility, because right now volatility is so low, it's really not worth even trying to trade. And it was just one of those things that's kind of like, okay, big, clear indication that you don't know what's going on. Because I feel like that was one of the most important developments that I had was, well, first realizing that there's days that it's just not worth even trying to trade. I think I kind of figured that one out pretty early on. But then knowing when those days are took a while. Took a lot of learning. I think that that's probably one of the best things that you can use to tell if a particular trader really knows what they're doing, is how good they are at being able to predict whether today is going to be a good day to trade or not. Did you change your contracts? It's rollover time, but I didn't check the volume of the old and new ones. Well, so I did the rollover for the currencies, essentially. I don't think it's time to move oil yet. But yeah, we're still on January for oil. Then everything else we're on. Oh, no, wait. Why am I on... January is F. So why is oil on H? Shouldn't oil be on F? Ah, there's much more liquidity in F. But the rest of them are all correct, right? March, H. ZT is H. And then the 10-year should be on, still be on December. The micro treasury yield futures, that is. I don't know, the thing about the influencer space, though, is particularly in day trading that I don't understand is how there are so many of these people out there that seem to get a good amount of attention, at least on TikTok. I'm not going to say that they're becoming like full-on influencers or anything like that, but I see a lot of people that they get way more likes on their posts than I think I've ever gotten. And everything that they're posting is complete trash. I just don't get it. Marketing, something. I mean, the thing is that I could understand like why somebody would get more attention than me. But then if they're not even doing anything, like how do I put this? I don't think I'm putting it very well. I think that somebody could come in and you do the right kind of marketing and you do a lot of things that I don't do because I don't think that they're moral to do. Like I don't think that it's moral for me to come in and try and convince people or influence people to day trade. I really think that by and large, day trading is not for most people. And I'm only interested in the people that are already addicted to it, right? Like people that have already decided that is their calling in life, is day trading. They've already had a taste of it, and despite completely failing at it, and despite knowing that they will probably never be successful at it, they still want to do it. Those are my people, right? So that alone kind of narrows my audience, right? But like I come across all of these people that like they're not marketing, they're not doing anything in their content from what I can see that would make them would make them get more views. And yet they do. And I don't get it. What am I missing? What is it that they're doing that I'm not seeing that's bringing them the views? I don't get it. Do you believe it to always be genuine real likes or comments from intelligent people, or is it often monkeys screaming together on TikTok? So most of the ones that I'm seeing don't get a lot of comments, but they do get likes. Like they'll get like in the range of like 80 to 100 likes. And sure, they advertise to morons, but like I don't think if all of the sudden I started gearing my content towards and was attempting to attract morons, they wouldn't come. How are they attracting them? Because the content that I see is just nonsense. Like, what is it that's in that that's going to make somebody be like, ah, yeah, that's my thing. That's the stuff that I want to watch. I'm going to like that. I don't get it. Unless a long time ago, in a post that I never saw, they posted some big winner and they're just running off of on the laurels of that. Honestly, I do think that the majority of the people in the day trading space who become quote unquote successful influencers had one period where they did really, really well, and they're just writing that. Reminds me of another post I saw on Reddit where they were talking about I can't even remember her name. It was a female trader though. And they were complaining that like the subreddit as a whole didn't like her. But then there was this other guy that they claim is legit that has like verified results and he does like her. But then like the top comment was like, well, he also liked this guy, and this guy, and those are all scammers. So doesn't necessarily mean that this guy knows what he's talking about. How would you place your scalps? I wouldn't. How would you place your stops in a market like NQ? I wouldn't. Well, first of all, I wouldn't scalp NQ in the first place. That's just the big one. But you got to realize if the market, it's Gaussian motion. Like if you think about it on a short time frame, you can think of it as Gaussian motion, which means that there is a range of possibilities about where the market is going to go from here. It's like that you've probably seen these cones, right? Kind of does this thing, and there's all these ranges of possibilities in between, and you get this kind of this cloud. And this cloud is essentially what your measures of volatility are telling you is how wide that cone is right now. So when you're placing a stop, really what you're doing is you're saying, based on how big your stop is relative to the current volatility of the market, your stop is going to get hit a certain percentage of the time. And the market is extremely efficient on a risk-adjusted basis, which means that if you have the stop far enough away that it only gets hit 25% of the time, then that means that when it does get hit, you're losing like 3 times more than when you win usually. So putting a stop, basically like a set stop, and when I say a set stop, I mean it's the same number of ticks away every time. Like I say, I'm going to give myself 20 ticks in NQ. Okay? Then that act alone will cause your results to tend to converge on random. Just that alone. Because it's volatility. Right? So if you don't want to just be beholden to the outlays of market volatility, which honestly, you don't. If you want to trade volatility, then you're probably better off either trading options outright and selling options, or doing what we do often, knowing where the limits of the day are supposed to be and fading those. Okay. You have to have some other way of setting your stop to be able to say, you know, I'm getting out now because the trade has been invalidated, and so I'm actually getting out closer, right? That way, you can get this sort of a thing where, like, yeah, maybe you only get winners 50% of the time still, but when I lose, I'm losing less than my winners because I know when the trade is invalidated, right? And it's based on something that I'm predicting rather than just the random Gaussian motion of the market. You see? You have to pull yourself out of the randomness. So, like, here's the thing. If you really want to just have a number that's like certain number of ticks away, I have that large enough stop and that's going to protect me, then you have to have a stop that is larger than the current volatility of the market, which is going to be way bigger than any day trader is going to be able to take. And at that point, you know, let's say you get a big enough account that you're able to hold that, well, then you're going to have profit targets that are equally as generous. And at that point, you're a swing trader, right? Then you're just trading momentum. You might as well just trade momentum at that point. So set stops and targets for scalping don't actually make any statistical sense. And everybody has some idea in their mind that, like, there's some magical number or place based off of the chart that I can put it, but it doesn't work like that. I've never found a technical signal that reduces adverse excursion. That is, ticks against you. Let's see here. My problem was also usually risking too much per trade, though, so my comments can be loved or ignored. Oh, yeah, totally. Well, like, I haven't really... I probably should try and practice this a little bit more when I'm taking these practice trades over here. But, like, you should have a stop. Because you don't want to have a move where the market moves, you know, here in the Treasuries, let's say, if the market were to move $1,000 on me, right? That's about on par with some of the biggest moves that I've seen. Okay, so if there's a full handle move in the Treasuries, you don't want to eat that whole thing, right? But you should have a stop that is not in any normal circumstance going to get hit. It's going to be way further away than... So here in the Treasuries, average swing is about 5 to 6 ticks. So if you're going to have a stop, probably should be further than that. And on the other hand, hopefully, if I'm wrong, I'm realizing that I'm wrong before it makes 6 ticks, right? So I don't automatically stop out of those, but I do get out long before them. And on the other side, when I'm letting it go, I don't say, well, it's gone 6 ticks, and so that's where I take my profit. No. I go until there's a liquidity hole, until I know that the meta order is likely done. I'm predicting the amount of volume or imbalance that's going to come into the instrument and basing what I do off of that. Do you work with options as well? So I've only ever taken a few, and I really think it's a few, 3 or 4 options trades. But I do know a lot about options, so I can absolutely answer your questions about options. If I had a larger account, I probably would spend a lot more time with options. Like, I think I think if all of the sudden one day, because hey, who knows, it could still happen. I have some really good content on this YouTube. I really do. I don't think that when it comes to like my VOD content, I don't think anything comes even remotely close. And I am hearing a lot of people saying, like with TikTok in particular, but I think YouTube is kind of doing it as well, that the platforms are starting to get more interested in long form content and more informational content. So there's still a chance that the YouTube channel could just all of a sudden take off, and from the YouTube advertising alone, I'm making millions of dollars from it, right? So if I all of a sudden had a few $1 million, I was able to put a little bit of it, you know, pay off the house and or, well, probably move, because you're rich, you need to have security, right? And you have enough savings at that point. You know, you have $2 or $3 million in savings, so you could just live off of the savings if you wanted to. And then even after that, I still had like $100,000 to just blow on trading. I would probably trade options. I would probably just sell options. Well, not probably just, but that would be probably one of the things I would do that would probably be the most consistent profit generator for me. Because I think I've gotten pretty okay at knowing when that fat tail is coming along, and that you don't actually want to hold the options against it, right? Well, that's another thing. I saw some people talking about this, and I was like, you know, that's actually a pretty good way of looking at it. They call it the nothing ever happens trade. It's totally it. Is that pretty much every month there is something that investors get uppity about, and nothing ever happens. It's maybe like once every 3 to 5 years that something significant happens where holding against that move ends up screwing you over. Okay, I trade on gold CFDs, so I analyze order flow using in Bookmap. So is it helpful if I also analyze gold options? Can you explain a little bit about it? Okay, so there is a lot that you can do with the options. So let's talk about some of the things that you can do with the options just from looking at the options, okay? The first thing is you can look at the near-term options. So like if we come over here to bar charts, barchart.com, because this gives you pretty good data for the options. You come in here and I go options quotes. Okay. Now you can see there's this line between the ones that are dark colored and the ones that are light colored. So these are the ones that are basically below the current price, and these are the ones that are above the current price. Okay. So you can look at the puts and calls at that near term, that the at the money. This line is the money, right? So you can look at the options at the money, and there's sophisticated calculation that you can do that basically says, based on the price of this option, what are they expecting the yearly volatility of this instrument to be? Okay. Now, bar charts puts it for you up at the very top. It basically says, based on the at the money options, you will make or lose 4.68% per year. Okay. So what you can do is you can then take that and you can divide it by the square root of 255, which is the number of trading days in a year. And you take the square root of it because that's how you convert between different time frames. And so you take the square root of 255 times 4.68, and that is the expected move on a daily basis. So I have an indicator that goes and scrapes this number for you and does all of the calculations, and that's what you're seeing in this chart that I have up on the upper left. Okay. These lines are basically where we're expecting it to go based on that number. Okay, so that's the first thing that you can do. The second one that you can do, depending on what data you have available to you, unfortunately for the treasuries, I don't think that they do this, but they have it for the equities here on barchart.com, is you can look at the gamma. So the gamma is basically like, if I'm a market maker and I'm selling options, okay, so I want to make money from the time value of the option decaying down to 0. So if I'm doing that, then what happens if I sell a call and then the price of it goes up? Well, that's really bad for me, right? So what do I do as a market maker? I buy the underlying. I buy the underlying and then I sell the call on the underlying. And that way, whatever I'm losing on the option, I'm making on holding the actual underlying instrument. And so I'm hedged, essentially, right? So normally it would be like, if it's stocks, you know, an option is 100 shares, right? So I would sell one option. I would sell one call option and I would buy 100 shares. Okay. Problem. The delta for an option changes as price gets further away from your strike price. So there is essentially a point at which if price gets far enough away from that strike that you have to buy more contracts to keep yourself completely hedged. If we were to graph it, right, as if you sell an option, right, you make money if it stays below. We're selling a put. So we make money if it stays below the strike price, which will be this vertical line right here. And then as it's above the strike price, we're losing money, right? So what we do is we long the stock, which would be this line, and these cancel each other out so that I still just make the time decay, okay? The problem is that this line right here, if I were to draw it back again, is not actually straight. It actually is like this. It curves, okay? The curve of this line is called gamma. Okay, delta is like the slope, how much this is going down, and gamma is how much it curves. Okay, so based on the gamma of the market, there is a point at which people that are hedged have to hedge even more. So the more that the stock price goes up, the more that those market makers have to buy, essentially. Okay, so that's what this is. This is showing you the gamma. So, and what it essentially means is when you have a positive gamma, they actually have to reduce their positions in order to be correctly hedged. And if the gamma is negative, then they would have to add to positions to be correctly hedged. Okay, which basically leaves you with this sort of thing where when you get below these prices, so like this one's 68.30. 68.30 has a lot of negative gamma on it. So if we were to get below 68.30 and it started to become clear that we were going to close below 68.30, then you would probably start to see more selling. It would probably extend the move as those option market makers try to properly hedge the position that they know is going to close below that price. Okay, so that's another thing that you can kind of look at with the options that can help you. Now, to get that information on gold, you're probably going to have to pay for a service like spotgamma.com. Okay. Now, related to the options, but well, it's not options, but it's a similar-ish kind of idea, is the commitment of trader reports. So if I come in here, well, let's because you're asking about gold, let's do it in gold. Gold futures. And we're going to do daily charts. I'll load up a daily chart of gold. And then Ninja Trader has this nifty indicator called COT, I believe, that you can add. And it tells you, well, there's a lot of different series that you can add on here. So the blue is going to be non-commercial, red is going to be commercial, and the green is going to be the non-reportables. Okay. It's going to take it a while to scrape the data and pull it in there. Okay. And you kind of get this idea. So the commercials, you see this? When we were going up, the commercials were buying it. That's something worth paying attention to. I saw this thing the other day. I don't remember the name of the guy, but basically there's this guy that's super famous from the whatever the name of that trading contest is, which is basically a trading contest created for swing traders, for momentum traders. And he did a webinar where he kind of explained what he was doing. And he basically explained that he was trading momentum based on the COT report. He was basically saying if he was seeing the commercials doing something, and then he would trade the momentum of the commercials. So there you go, right there. That's kind of interesting take. But that's another thing that you can kind of use that's kind of like, because really what you're looking at is you're looking at meta information about the positioning of the overall participants in the market is really what all of those things are, right? Because what are we ultimately trying to do? We're trying to predict future orders. If all you do is analyze price, there's too much noise in price to really pull anything out of that. So what do you do instead? You analyze what the participants themselves are doing. So COT report is useful because it splits the participants up into different types so that you can see who's doing what. And by doing that, you might be able to pull information out that's actually predictive. Can you please give a guide on Forex Factory and knowing which report will affect which market? Oh, well, that's tough, dude. So if we come over here to Forex Factory, the issue with the Forex Factory guide is that it's for Forex, right? So when you come in here and you look at, like, Moran is supposed to be speaking in 10 minutes, although I don't know. Moderated discussion about inflation, interest rates, and monetary policy. Oh, you know what? Earlier it didn't have this one. Only had this one. This one is going to be on CNBC. It's going to be on CNBC, but he's also going to be doing something at Columbia University. Okay. And then it gives a description. Why traders care. Federal Reserve FOMC members vote on where to set the nation's key interest rates, and their public engagements are often used to drop subtle clues regarding future monetary policy. Now, they also have these little impact things, right? Low impact expected, medium impact. And that is based on the indicator or whatever it is and Forex. So for Forex, FOMC member speaking, yeah, low impact, maybe that's correct. But for Treasury traders, in this particular situation, what Moran says is the most important thing for us today. So what you can do is I would just come in here and come and set this to this month. Okay. For every one of these, especially the ones that are like high impact expected. Okay. PMIs are very heavily watched because this is the most forward looking indicator that we get. These are purchasing manager indexes. So these are like people in the warehouse purchasing inventory. This is where you see the demand first. Okay. Come in and then it'll give you source. So you come in and you click the source, right? And then we've got the manufacturing and services PMI, and you can view the report, right? So this whole big thing, right? So come in, and for everyone that's read this report. Read the report and see what the last one was and understand what they're talking about and why this kind of information is important for barometers of the economy, right? And then, you know, once you've kind of read all of those and you've also read like the descriptions and stuff on Forex Factory, then you're going to have to ask yourself some questions about what it means for your specific instruments, which is basically going to be like who actually buys and sells this particular thing and how do those particular things affect the supply and demand in my particular instrument. So depending on the market, might be harder or easier, right? Some of these markets like gold and Bitcoin, there's a lot of speculation in it. And so how much does the economic news affect them? Well, it affects them, but it's kind of not as significant as it is like in the treasuries or the equities. All right. But you're all smart. When you go and you read and you digest all of that information and you do that, you follow every report for a couple of months, you very quickly get an intuition for it. And you will also start to get an intuition for like what we would call the metagame, which is like, what do investors care about right now? What's everybody kind of focused on? The metagame is like it's way better to explain in video games, right? Like StarCraft. If everybody in StarCraft is doing 5-pool rush, which is you get the first 5 or you get the first 6 attackers out as quickly as you can and you go and you attack them, well then everybody kind of has to defend themselves against these rush strategies, right? And people kind of know what's popular at that time, and that kind of affects what you do. So once you've been doing this for a few months, you kind of get a good idea for the metagame. We're going to reach 7,000. Are we that close? Nah. 150 points today? I mean, it's possible, but that seems a little excessive. Especially where we've been. But, you know, before the end of the year, I think it's possible. For the end of the year, it's possible. Okay, so I missed this one. If market maker sells stock, puts to, I don't know what SMBY means, but then market makers buy shares to hedge. Yes. No, if the market maker sells options, so yeah, if you, so now we have to get into the, what are the options, right? So a call is an option to buy. So if you buy a call, then that call, that option to buy is going to be worth more the higher that the stock gets above your strike price. Okay. So calls are essentially like going long the stock, and puts are essentially going short the stock, right? So the market maker, when they're selling the options, they're taking the opposite of that. Okay, so if you were to draw it out on our chart, just think through the logic of each of the options. Okay, if a call is I lose money if it's below my strike price, and I make money if it goes above my strike price, right? So selling the call is going to be the opposite of that, or rather it's going to be flipped around the x-axis, right? You make money if it's above the strike price, and you lose money if it goes below it, right? So if you are selling calls, then you have to buy the stock to hedge. And if you're selling puts, then you have to sell the stock to hedge. So close. Maybe tomorrow if news is good. Maybe. So the thing that I'm kind of wondering, actually now is a really, really good time for my mind to wander over to this subject. It really feels to me like Oracle has become a curious bellwether stock. So, what are they doing here today? Okay. Well, they got hammered on Friday, but it looks like they're okay from there. So we'll see what they do this morning. If Oracle decides to dive lower, which I don't know why they would, but I'm just saying. I think that if Oracle goes lower, that it probably takes the rest of the market with it. Do you only read the red reports? No, I read pretty much all of them. But you can start with the red ones. Because I would think that once you've read the all of the red ones, you would probably understand things enough at that point to understand which of these lighter impact ones do and don't matter. You know, like this RCM tip, economic optimism. I don't think I've ever paid attention to that. I've never seen that. Words total vehicle sales. Not really one that I've ever heard of before. Import prices. Well, they say low impact, but that one there's usually a little bit of movement on. Okay. PMIs are always very important. Okay. This Challenger job cuts has been an important indicator as of late. They have that one as medium. I guess most of the ones that are marked as low impact are typically pretty trivial, but there's some of them that are actually. So like when you come into this one, Friday, like personal income and personal spending, they're marked as low, but those are actually can be really, really good tells about what's going on right now. So like big beats or misses in those can be really significant. But I guess probably the reason why Forex Factory would have those one listed as low is because it's very rare that these numbers are so far off of the expectation that it means anything. But if they are, those can be big deals, right? Here, if personal income came in like spot 5 versus spot 3, that probably treasuries would tank. Probably treasuries would tank in that case. But I would read all of them. Do you do backtests programmatically or just with market replay? I do them all programmatically. Like a back test that is done by hand or done discretionarily is worthless. You got to be able to prove it, especially like if I go and I do a back test and I say, okay, I've gone through this chart by hand and it shows X. Don't expect anybody else to believe that, right? Like, the whole thing is empirical. What makes something empirical is that other people are able to go and look at the same data or collect data about the same phenomenon and verify the same thing, right? Like, if I drop a ball from a certain height and time how long it takes that ball to fall, I can go and I can repeat that anywhere and collect that data, the amount of time that it takes for it to fall. And that is empirical evidence. And other people can go and collect the same data and see the same thing. And then we can say what it does. Well, it tends to follow this rule that about acceleration and velocity. Basically Newton's laws, right? So in order for it to be empirical, somebody else has to be able to verify it, which is why you've got to do it programmatically. Like, if I give you the program, then you can go out and you can run it yourself against any data set you want and see that the claimed properties are there. And that's what makes it empirical. If you just went and did it by hand, then that's anecdotal, not empirical. What? Oh, where's the van? Oh, did I put it in my over by? I misplaced the keys. My wife just came in and asked me where the van key was. Now, another note is that Ninja Trader has like this market replay thing, but it's kind of wonky, so I've never really messed with it. It can be useful, like you're making a change to an algorithm and it seems to do things differently live than it does when you're doing like a historical backtest. Then doing the replay can be useful to debug it, but otherwise don't mess with it. Okay, so now in the last minute, Oracle is starting out on the wrong foot. It's not too bad compared to Friday, but it did start selling, so that's not a good sign. Scalp around a volatile market like NQ, CLGC, would you put something like a 50 points as protection? Yeah. So I have an indicator that kind of helps you figure those sorts of things out. Like if we did NQ here. NQ. And on this one, we want to do like 30-minute bars. 30-minute bars. And then I come in and I add the range histogram to this. Speculator Seth. Range histogram. Then I like to do it by saying use area 0.5. Because, you know, some points are worth more than others, right? So it's basically saying, oops, if I could guarantee that I made money on all of the bars that were less than 260, or if we were to say I was in the market all the time, I would make money on all of the bars that are blue and I would lose money on all of the bars that are white. And the bars that are blue and the bars that are white, when you add them all together, are the same sum, is what this calculation does. So that is why it kind of is an interesting spot to look at. So if on average I'm going to hold it 30 minutes, it looks like that on NQ to really be safe, you need to have about 270 ticks, which is a lot. That's why I don't trade NQ. It's the Widowmaker. The volatility of it is way higher than most people have the account for, but they still try trading it anyways. If live trading is weird, tick replay won't help debug it because the difference between the live and historical is invalid if you are sure the data used is correct. Yeah, there are some slight differences between, like, oh wait, no, wait, I missed your other comment. Because if it does things differently live, it's because of the fill knot of the tick data, because I assume it uses the same tick data to do the historical backtest for the replay. No, it's, so there's a few differences. So one is that if you're using something like cumulative delta, your cumulative delta that you'll get on the replay should be the same as what you got when you did it live, but it may be different from what you get from tick replay. So there's that. But there's also some strange sequences that can happen. So for instance, you can have logic in your algorithm that gets called on each tick, or, you know, there's just some code that will get called live that doesn't necessarily get called when the backtester is doing it. So there can be differences. So, and this would be like really bizarre things. It's like you have this whole setup and it should be entering in on this signal. And it says it in the, let's not involve order flow in it. Let's say that it's just price, because I have seen it with just price, right? You're doing the back test and in just price, it enters, but then you do it live and it doesn't enter at all. And you're like, what the heck? And then you're going to go in and you're going to do the replay or just debug it live, and you'll find these strange differences that didn't exist in your data. I can't really think of what they are at the moment. But there definitely are some things like that. But we've always debugged those live rather than doing it the replay ones. Doing the Ninja Trader replay at least. Because even when you do the Ninja Trader replay, like the way that the data plays back to you is not quite the same as it does live. It's kind of strange and choppy and stuff. Okay, so what we're seeing at the moment is flight to safety trade. And how much? Well, I'm not seeing really enough volume in the treasuries to really have me off of the, like, volatility is really truly breaking yet. But we did make a pretty good move up, and if the S&P 500 is going to go down for more, which, by the way, we said 68.30, didn't we? Yes, 68.30. So they've still got a ways to go. Am I? Oh, you know what? This one is wrong. This is wrong. ESH. Better. Well, that's actually, I'm a little bit skeptical about that now. Did I read that correctly? Gamma exposure. $68.30. But we were below that. Well, basically, we started at that. So that's interesting. And the options expire this week, right? Yes, the 19th. I don't know, guys. That has me a little bit concerned. Well, that 6,900, the big square number, or rather round number, they always pay attention to that. So that's going to be the next kind of spot to look for. But, no. Oh, you know, I have my new squawk on. Did we get anything from Moran? Faster fall expected in PCE, shelter inflation, shelter disinflation seen offsetting any higher goods inflation. Keeping policy too tight will lead to job losses. Okay. So his speech may also be a dovish thing pushing the treasuries up. But that probably wouldn't cause the equities to sell. So unclear to me if it is the treasuries would be up because of Moran or because of selling in the E-minis, or which of those two it is. I made a notebook with some nice findings, only crypto, but it can be adapted to any market's blob data. Basically, it's for testing of imbalance predictive power on different time horizons. Oh, that's interesting. But I would think that, like, what you should find is that the imbalance is only predictive on a hyper short time frame, right? It can go up to 10 seconds? Okay. 10 seconds is maybe... I mean, in the treasuries, like, we're only talking about, like, a tick or two. I'm more interested in the one... Did you see the one where they basically, they would add a filter? So, you're only filtering for, like, let's say in the treasuries, I only count changes in the limit orders of more than 500. And then you turn each change based on how many ticks away from the best bid, best offer it is into a token, and put all of that into a large language model and make predictions off of that. I think that would be a more, I think that, because just the imbalance on the inside is kind of a little bit like, well. Can you explain what is price settlement? So what they're probably referring to by price settlement is in some futures, they are cash settled. So if you are holding the instrument into the settlement date, then you will get paid according to the settlement price, which in equity indexes, interestingly enough, is the opening price the next day. So that might be why you might see people talk about the settlement price, because equity indexes are cash settled futures. And so if you hold the future all the way into the expiration, then the amount that you pay or lose is based on the settlement price, which would be the opening the next day in the equity indexes. Or if you were holding treasuries into the settlement day, right? then you're agreeing to buy or sell based on the price when it settles. But it's a little bit different for that because you can get called to deliver before settlement day. Like after first call, you can be assigned. So, different thing. I do weighted. I haven't seen that, but I think you need thick. Well, so the study that I read. So this was a study that one of Jean-Philippe Bouchot's graduate students did, I think. So if you look up his name, he's on the study. You can go and find it. It's something about large language models. But obviously, you change the filter depending on the size of the market. And the larger that you make it, the less tokens that you're going to get. But basically what you're going to be able to do with that is sequential stuff, right? Because if I come in and I say, okay, is the bid larger or smaller than the ask? And what does that kind of tell me? Okay, but what if the bid was really, really big and then there was a teeny tiny little market buy order and all of those offers canceled immediately, and then the rest of it were bought up and yada, yada, yada. Like there's a sequence of events that happens. And is there a certain sequence of events, order flow events, that can predict price going up? And we find that, yes, actually there is. That on short time frames that there are some very predictive signals like that. And they pass it into a large language model to sort out what those patterns are. And they're also able to categorize the market into different types of markets based on the behavior of the order book at the time. In thin markets, I've seen the opposite. Oh, well, okay. So, first of all, I should just point out in our trades, quotes, and prices book, they spend a lot of time talking about how there are behaviors that are different depending on whether it's a thin tick or a thick tick instrument. So that's definitely a thing. But on next order book change, the imbalance predicts mean reversion due to immediate lack of liquidity after the bid-ask cleaning instead of continuation. So you're saying if we tick up and there's like no liquidity there, that actually tends to predict a mean reversion. I think you're probably right. Like what I have found is you will, something like that is like a continuation signal for like a few seconds. And then if it doesn't go, then that has a tendency to create the liquidity hole. So either a lot of volume trading at that spot or it almost seeming to just completely skip over a spot. Because what really does it? A lack of latent liquidity. So if you're just coming along and all of a sudden there's a lack of resting liquidity at the spot, that can possibly tell you that the latent liquidity is low as well, and it tends to revert there. Yeah. But it very much depends. It's kind of interesting, though, because those are kind of two polar opposites and to some extent, right? Like if we traded up and like 20,000 traded at 15 is very different from if we traded up and it only took 500 contracts to clear 15. Those are like polar opposites, right? But they both kind of have this mean reverting effect. Versus I trade 3,000 here. I don't know, a lot of this pulls, but then when it trades, it still trades a lot. Because really, when you get a good trend, that's what you're going to see is they're just clearing them out. 3,000, 3,000, 3,000, and it just keeps going. Keeps going until it gets to a spot where something weird happens with the liquidity. So it's kind of the extremes, right? Like most events kind of happen in between, right? But I'm interested in that study because that study is much more in line with like how we as retail traders read the DOM, right? I really don't think that most of us as retail traders are only looking at the inside bid and offer and making all of our decisions based off of that. Because like really
block sell.
Well, okay, so there's a spot right there. Because really what's happening is if the bid or the offer gets too low, then you get a lot of people trying to catch the edge, and that's why it's predictive, right? Okay, so there was a big buy and then a big sell at 15. So there does appear to be a pretty big buyer going in here, and the S&P was hitting the lows again here. So SPOOs haven't really hit the decision point yet. So 15 could be a liquidity hole, or could become a liquidity hole rather. I'd say that the liquidity is still pretty healthy at the moment. So at the moment, I think it's still screaming continuation, but we're far enough into the move that I have to be wary. Like, you notice I'm not like trying to get in off of that. Really should have done it at like, no, I think I'm okay with just having not taken one yet. If I had more time, maybe it would make sense. That catching the edge is how I explain to myself the mean reversion, because if people build the bid, it means the price might be too high for them to enter at market. Yeah. But after it ticks down and imbalance is high on the opposite, they buy it and it ticks back. Yeah. No, what do you mean by imbalance is high on the opposite? You mean if we were to tick down and there was a really strong offer on it, then that tends to be mean reverting? Which is to say that they will buy it back? I don't know if I follow on that one. So I definitely feel that if you get a solid tick up and it's accompanied by a strong bid or offer following it up, that's usually a pretty strong sign that I mean, they're all kind of tea leaves, right? But I would say that tends to predict continuation, not mean reversion. On 0.1 seconds. Okay. I mean, I guess it is the case that, like, if I get a big bid, like you could see right here, when we took out that price at 15 and they put a strong bid on it, a lot of orders hit back into it for sure. I'll send the note. Okay. Okay, so there's a breach of 6,900. Now I've got about 8 minutes left here. I think I have a tenth of an idea what you mean, how I word it in my head. The market likes to move up negatively and down positively. Well, okay, so wait, let's talk about what is your metric. So are you saying I take the bid, the amount that's on bid, minus the amount that is on offer, and that is the net imbalance on the inside. And so if it is, it likes to move up negatively. So if the bid is higher, then it will tend to move up. So I think that is saying what I am, that like a strong bid is a sign that it's going up. But we just have our signs mixed up, maybe? Or do you do it the opposite? You take the bid minus the offer so that a negative number is a... You get what I mean? Oh boy. So I totally forgot about all of the shootings and stuff that happened over the weekend, and we didn't talk about it at all, which I don't think, you know, I don't like to focus on those too much, but I do think that something's going on that I think could have a big impact on politics, and I suspect that it will be something that helps conservatives. Because too many of these shootings as of late have been from Muslim extremists. And the two that we had were both, at least from the initial indications, were Islamic extremists. I just saw a thing here, Australian Prime Minister Anthony Albanese's response to the Islamist massacre on Bondi Beach that killed 15, stating that his main concern is the rise of right-wing extremism and that he plans to implement harsher gun control. I don't think that that is a narrative that is going to make any voter feel better. So we will continue to monitor that, but I think I'm detecting that this thing has kind of been like a slow brewing thing, and that it's going to start to have larger consequences. I mean, I'm definitely seeing people on the right raise their rhetoric against immigration from Islamic countries. But I think people are starting to pay attention to it more. Like, they're responding to people starting to resonate with the message. So I got 3 minutes. I was hoping Apol was going to respond there again. What is the calculation for the thing? Is it ask minus bid or bid minus ask? Yeah, for your inbound, the primary calculation that your notebook is collecting statistics on. Because I'm going to be thinking about it all day. Bid minus ask divided by bid plus ask. Okay. So bid minus ask. Okay, so if the bid is larger than the ask, then you get a positive number. And you're saying that it likes to move up negatively. That it likes to move up when the ask is larger. At least on a 0.1 second time frame. So would that imply that the big guys wait for that offer to be strong enough before they hit it? Send it on Discord. Oh, okay. But you also turn it into a percentage. That's interesting in and of itself. Did you try doing it just on the absolute number? What if you do it on just, what if you do stats on just the absolute number? When negative ask is bigger, when positive bid is bigger. Okay. Yeah, getting the way that the signs are is definitely matters. I can't even remember. Like, I have some indicators there that would that can give you that imbalance, but you have to kind of set things up all different ways. Are micros and minis yes. Pretty much everything else about them other than the size tends to be the same. Yeah, so like the thing that I find interesting about, so I think that the bias that the way that you're doing it would probably bring in though, is that these places where the imbalance is like really close to -1 or 1 are going to be situations where like the bid is normal and there's hardly anything on offer, right? Which tend to be places where people catch the edge. So I don't know. Those ones aren't as, you know, like what am I trying to say here? I feel like that when one side is really big and one side is really small, that tends to be areas where we just go back and forth across that price and they aren't as significant. And what would matter more to me is like what just happened there, where we ticked up and there's like immediately 3K on the bid, right? And if you were looking at your indicator, right, that would probably just come out as like a 0. And do you see anything significant about it there, right? Versus if you weren't using a normalized indication, you were just looking at the absolute difference between them, but you can kind of start to see, even if we did that, there's still some problems with it, right? Because I'm not able to tell, like I could get the same imbalance number, like let's say that the imbalance is 100, and it could be that there's like 300 on the bid and 200 on the offer, but it could also be that there is 4,000 on the bid and 4,000. Anyways, you get what I mean. I forgot the numbers that I was using, so I don't remember. You know, I said 200, so it would have to be 2,800. Okay. Anyways, but if you use the large language model approach, then it's looking at what changed, how many orders got taken out, and how many orders canceled. Oh, I got a bit behind though because he had an interesting. Oh, I gotcha. Yeah. Anyways, you should try the large. Like I would, given what you've done so far, the large language model thing probably wouldn't be too hard, assuming you have a good graphics card. Because you just have to take the change and turn it into a token. Okay, but to go back to what we said earlier, there was a big order at 15, and I said that could be an area of mean reversion, but there was pretty healthy liquidity, so I wasn't getting this, like, the signs that the liquidity was stressed enough yet. And there's still a question about, will the S&P 500 continue to sell, right? Well, it looks like the S&P 500 continued to sell, and so the treasuries continued to buy. So in this case, I think in order for us to predict that we were going to continue through here, we would have to know that the order flow was going to continue to be negative in the equity indexes, which I do think is something that we could know just because of the gamma and because of Oracle and everything else going on. You know, I think that it would be at least reasonable to make a prediction that we would sell in the equities, but that was not necessarily a prediction that I made because, well, you know, it's equity indexes. So what you can do. But now we are hitting on the regular session, the first level. So there is a step further at 17.5. But I would expect there to be a little bit more resistance here now. So we'll see if they're able to go further than that. If they're able to break that, then man, this thing could be really off to the races. But so far, in fact, I'm taking a look at this here. Kind of looks to me like the E-mini is already starting to revert here, so I don't think I don't know if it's like it. Well, okay, it's already down 3 ticks, but basically that what I was getting at is there's some resistance here, if not some mean reversion. I don't know, I came back to 15 pretty quickly, so maybe the opportunity's already passed. Because on those mean reversion plays, I don't know. Uzi says that he can take it all the way back across the range, but so far I've only been able to get a few ticks off of him. Anyways, I spent too much time talking about that. It's time for me to go. Time's too short. Well, I don't know. Next week, because I won't be working next week. But I don't know if we're gonna really stream. I might just not stream at all next week. But probably we work on the trading GUI a little bit more, I think. Anyways, I'll see you guys tomorrow. Don't miss it. It's going to be a big one. That the non-farms and retail sales. So, in the meantime, stay excellent.